The 401k decision you can't undo, company stock, and the six-figure mistake. There is a checkbox on a standard 401k rollover form that can cost you more than $100,000. It doesn't look dangerous, it's the obvious choice. It's the one the call center representative will walk you through in about 90 seconds. And once you check it, the decision is permanent. There is no amendment, no correction, no do-over. Here's the situation. You're leaving a job, retiring, quitting, or laid off. It doesn't matter which. Inside your 401k, you're holding stock in the company you worked for. Maybe it came from an employer match. Maybe you bought it through a plan option over 15 or 20 years. Either way, it has grown a lot. If you roll that entire account into an IRA, the default, the thing nearly everybody does, every dollar you eventually withdraw gets taxed as ordinary income, up to 37% federal. But there is a provision in the tax code that lets you pay long-term capital gains rates on the growth instead. In the example we'll walk through in this video, that single difference is worth about $115,000. It's called Net Unrealized Appreciation. And the moment you roll those shares into an IRA, it is gone forever. This is education, not advice. Let's get into it. Let's define the term because it sounds more complicated than it is. Net unrealized appreciation is the difference between what your employer stock is worth today and what the plan originally paid for it. That's it. That's the whole concept. Say the shares in your 401k are worth $800,000 today. Over the years, the plan acquired them for a total of $120,000. That $120,000 is the cost basis. The remaining $680,000 of growth, that is your net unrealized appreciation. Now here's why the distinction matters. Normally, everything inside a traditional 401k or IRA is treated identically when it comes out. It doesn't matter whether a dollar was a contribution or a gain. Every dollar is ordinary income taxed at your regular income tax rate. The NUA provision carves out an exception, and it is the only exception like it in the retirement system. It says, if you hold appreciated employer stock in a qualified plan, you may separate those two pieces, pay ordinary income tax on the cost basis, and pay long-term capital gains rates on the appreciation. For 2026, ordinary income tops out at 37% federal. Long-term capital gains top out at 20%, plus a 3.8% net investment income tax for higher earners, so 23.8% at the very top. At the extreme, that is a 13.2 percentage point difference on the same money. But the top of the bracket isn't where most people live, so let's use realistic numbers. Same person, same $800,000 of company stock, same $120,000 cost basis. Two different decisions at the moment of leaving the job. Let's say this household is married, filing jointly, with enough other retirement income to sit in the 32% federal bracket and lands in the 15% long-term capital gains bracket when they sell. Path A, the default rollover. You move the entire 401k, including all the company stock, into a traditional IRA. Nothing is taxed today. The account keeps growing tax deferred. This feels safe, and for most of your 401k, it usually is. But now that company stock is IRA money, and IRA money has exactly one tax treatment, ordinary income on the way out. Every dollar, the $120,000 of basis and the $680,000 of growth are now indistinguishable. $800,000 taxed as ordinary income at 32% is roughly $256,000 in federal tax. Path B, the NUA election. Instead of rolling the stock over, you have the shares distributed in kind, meaning the actual shares move, not cash, into a regular taxable brokerage account. The rest of the 401k, everything that isn't company stock, still rolls into an IRA normally. You are not giving that up. Now the tax splits in two. The cost basis, $120,000, is taxable as ordinary income in the year of distribution. At 32%, that's $38,400. That bill is due now, and that's the real cost of this strategy. The appreciation, $680,000, is taxed at long-term capital gains rates when you sell the shares. At 15%, that's $102,000. The difference is $115,600 on exactly the same shares from exactly the same account, with the only variable being which box was checked on the way out the door. And there's a detail in Path B worth pausing on. The appreciation gets long-term capital gains treatment, regardless of how long you hold the shares after they leave the plan. You could distribute the shares on Monday and sell them Friday, and the NUA portion still receives long-term treatment. That is unusual, and it is written into the provision deliberately. One caution on that same point: any additional growth after the shares land in your brokerage account follows normal rules. Sell within a year of distribution, and that new gain is short-term. Only the NUA portion itself gets the automatic long-term treatment. Now the part that most videos on this topic leave out. NUA is not automatically better. It is a trade. You are paying ordinary income tax today on the cost basis in exchange for capital gains treatment later on. The appreciation, when the basis is small, that's a cheap trade. When the basis is large, it stops being one. Let's flip the example. Same $800,000 of stock, but this time the cost basis is $600,000 and the appreciation is only $200,000. Under the NUA election, you'd owe ordinary income tax on $600,000 right now. At 32%, that's $192,000 due this tax year out of pocket, and the $200,000 of appreciation at 15% adds $30,000. Call it $222,000 total. Under the plain rollover, that $800,000 stays sheltered. It comes out gradually across retirement, quite possibly in a 22 or 24% bracket rather than 32. And in the meantime, the money that would have gone to the tax bill is still invested and still compounding. In that version, NUA is clearly the worst choice. So the single biggest factor is the ratio of cost basis to current value. The lower the basis relative to the value, the stronger the case for NUA. The higher the basis, the weaker it gets. But it isn't the only factor. 4 others move the answer. Your bracket today versus in retirement. If you're about to drop from a high-earning year into a much lower income retirement, deferral gets more valuable and NUA gets less attractive. Your time horizon. The longer that money would have stayed compounding inside the IRA, the more the deferral is worth. Your state. Some states tax capital gains as ordinary income, which compresses the entire benefit. Some have no income tax at all, which widens it, and concentration risk, which has nothing to do with taxes. This whole strategy involves holding a large, undiversified position in one company's stock. If a meaningful share of your retirement is riding on a single employer, that is a portfolio question that outranks the tax question. The tax tail should not wag the dog. There is no universal break-even percentage, whatever you may read. It depends on all 5 of these together, and it depends on your actual numbers, which is genuinely a conversation for a tax professional with your plan statement in front of them. 4 conditions have to be met. Miss any one and the election isn't available. 1. The stock has to be in a qualified employer plan, a 401k, an ESOP, a profit-sharing plan, or a stock bonus plan. IRAs and SEP IRAs do not qualify, which is precisely why rolling first destroys the option. 2. There has to be a triggering event. Separating from service, and that includes quitting, retiring, or being laid off, or reaching age 59 and a half, or death, or disability. 3. It has to be a lump sum distribution. The entire balance of all accounts under that employer's qualified plans must be distributed within a single tax year. Now, this rule is very widely misunderstood, so let's be precise. The requirement is that the account be emptied, not that everything be taxed. It is entirely permissible, and it is the standard way this is done, to take only the employer stock as an in-kind distribution and roll everything else over to an IRA in that same tax year. You are not forced to blow up your whole retirement account to use this. 4. No disqualifying distribution beforehand. If you have already taken a partial distribution after your triggering event, it no longer qualifies as a lump sum distribution and the opportunity is closed. And one caveat on timing. If you're under 59 and a half, the cost basis portion, the piece taxed as ordinary income, may also be subject to the 10% early withdrawal penalty. There is a separate exception for separating from service in or after the year you turn 55, which applies to qualified plans. This is exactly the kind of detail where your specific age and your specific plan document determine the answer. One more piece, and it's the one that almost nobody covers. For the NUA portion, that is not true. Net Unrealized Appreciation does not receive a step up in basis at death. Under the tax code, it is treated as income in respect of a decedent, IRD, which means your heirs inherit the tax liability along with the shares. When they sell, they owe long-term capital gains on that NUA. There is a partial offset. Beneficiaries may be able to claim a deduction for federal estate taxes paid attributable to the NUA, which softens the double taxation effect, where estate tax was actually owed. So the growth splits into two pieces at death, treated differently. That is a real planning consideration, and it is one of the most frequently missed details in this entire area. 5 mistakes in the order they cost people money. 1. Rolling the entire 401k to an IRA on autopilot at separation. This is the big one. It is the default path. It takes 90 seconds, and it permanently forecloses the option. There is no fix afterward. 2. Not knowing the plan holds employer stock at all. This is more common than you'd think, particularly where the employer match was paid in company stock automatically. Plenty of people discover it years later. 3. Taking a partial distribution after the triggering event. It quietly breaks the lump sum requirement and disqualifies everything that follows. 4. Electing NUA when the cost basis is high. Paying a large ordinary income tax bill today to protect a small amount of appreciation is a bad trade, and it is irreversible in the other direction. 5. Assuming heirs get a step up on the NUA portion. They don't, and estate plans get built on that assumption. Notice what all 5 have in common. Every one of them is a decision made once, quietly, usually at a moment when someone is focused on starting a new job or beginning retirement, and none of them can be undone afterwards. So, back to that checkbox. If you hold appreciated employer stock in a 401k, an ESOP, or a stock bonus plan, and you're approaching a job change or retirement, the useful thing to do is simply find out 2 numbers before you sign anything: what the shares are worth and what the plan's cost basis in them is. Your plan administrator has both. Everything in this video turns on the relationship between those 2 figures. This has been educational content, not financial or tax advice. Plan rules vary, and the numbers here depend entirely on your own situation. Take them to a qualified tax professional before you act. If this was useful, the video on the screen now covers asset location, which accounts should hold which investments, and why it changes your after-tax return more than most people expect.